Question 18 is also going to discuss on options, and we are also going to see some reasons of hedging and why not to hedge and all those, and also about delta hedging, right? Delta hedging comes in your interest rate risk. So make sure that you go through this because delta hedging will come, right? There are 5 Greek variables: gamma, vega, theta, rho, and delta. Delta will come, right? So before this, let's go through the requirements. A. Estimate the number of OTC put options, over-the-counter put option contract, that Marengo company will need to hedge against any adverse movement in Marengo company share price. Provide a brief explanation of your answer. Note: you may assume that the delta of a put option is equivalent to N minus D1. This you have to know. Why? Because ND1, we know how to calculate ND1, but when it's for delta for put option, it will be N minus D1. So we have to estimate the number of OTC put option contracts. B. Discuss possible reasons for the suggestions made by each of the 3 managers and the CEO. So 3 managers and the CEO made some suggestions. You need to discuss the reasons for those suggestions. And it is for 18 marks. And by the way, in your paper, you will not get a question like this. A theory question, just 18 marks theory you will not get. This was asked before previously, right? Before 2018 paper. But now the syllabus has changed. But still we can go through the answer just to get the points. In case if you are asked this question, maybe you might be asked for 5 marks or 7 marks or 10 marks, so you should be able to get the points, right? Now let's go through the case study. Marengo. Okay, so the treasury division of Marengo, a large quoted company, holds equity investments in various companies around the world. One of the investments is in Arian company, in which Marengo holds 200,000 shares, which is around 2% of the total number of Arian company shares traded on the stock market. Over the past year, due to the general strength in the equity markets following optimistic predictions of the performance of the world economies, Marengo's investments have performed well. However, there is some concern the share price of the Arian may fall in the coming 2 months due to uncertainty in its market. It is expected that any fall in share price may be reversed following this period of uncertainty. The Treasury Division of Managers in Marengo, Venio, Lola, and Sam have met with the CEO, Edward, to discuss what to do with the investment in Aaron Company, and they each made a different suggestions as follows, right? This you need for your part B, because we need to give reasons for the suggestions by the 3 managers or CEOs. Let's see. What is it? Venue was of the opinion that Marengo shareholders would benefit most if no action were taken, so no action. He argued that the courses of action proposed to by Lola and Sam below would result in extra cost and possibly increase the risk to Marengo company. So no action because it will increase cost and also risk. Okay, that's what Venue is saying. Now let's go to the second one. Second is saying Lola. Lola proposed that Aaron Company's shares should be sold in order to eliminate the risk of a fall in the share price. So their shares has to be sold. That's what Lola is saying. Why? To eliminate the risk of a fall in the share price. To eliminate risk of fall in share price. Part C. Right, so Sam, let's see what Sam is saying. Sam suggested that the investment should be hedged using an appropriate derivative product. So Sam is saying hedged. Fourth, Edward does not understand why Marengo Company holds equity investments at all. He believes all shares should be sold. So Edward is not understanding why hold equity investment. All shares should be sold. That's what Edward believes. Interesting. So although no exchange traded derivative options exist on any company shares, a bank has offered over-the-counter option contracts at an exercise price of 350 cents per share in a contract size of 1,000 shares each for the appropriate time period. So it's an option contract. The exercise price is 350 cents per share. Contract size is 1,000 shares each for the appropriate time period. And Aaron Company share price is 340 cents per share. So 340 cents per share is the share price. That is your PA. Although the volatility of the share price would be as high as 40%, that is your volatility. It can be assumed that any company will not pay any dividend in a coming few months and that the appropriate interbank lending rate will be 4% over that period. So this 4% is your rate. Now, what we have to do? Part A, estimate the number of OTC put option contracts that needs to hedge against any adverse movement in their share price. Right? So now let's see how it has been done. Basically, you are using what? Black-Scholes model. See, Black-Scholes model, first you cannot use the Black-Scholes model to find put options directly. First, you have to find the call option, and then only we know that for put option delta, it will be N minus D1. So first we can find for D1, ND1. Then we can find for N minus D1. It's easy. So the number of the put options to be purchased depends on the hedge ratio, which in turn is determined by the options delta. So whenever they are saying to find the number of options, how many options is there? Indirectly, what are they saying? They are talking about hedge ratio. What is hedge ratio? How will you determine hedge ratio? It is determined by the options delta. So you need to read about delta to know what is this hedge ratio, option delta, and all those things, right? So the number of put options to be purchased depends on hedge ratio, which is in turn determined by options delta. We can estimate delta using this because it's a put option. So first we are going to write the formula for D1. Only we are going to work with D1, no D2 here. Okay. So price, share price, current share price is 340. Exercise price was 350. That's why it is 340 divided by 350. Then comes to R was 4%. Then 0.5, 0.5, and time, it was for 2 years. Let us see the time. Right? They have given us any time or not. Where is the time? Standard deviation is 40%, right? Yes, coming 2 months. So it is for 2 months, 2 over 12, because it is for 2 months. And then it is 0.4 into square root of 2 over 12. So once you get it, you are getting minus 0.06. It is D1 which is minus 0.06, but if it's minus D1, then it becomes positive, right? So what you need to do? Because when you see D1, it's minus, right? You want to find N minus D1. So you make it positive. Negative becomes positive, the number remains the same, right? Now, from the table, just work out the value of D1, which is 0.06 from your table, right? 0.06, it needs to be added, even though it's negative. But once you convert this to this, it becomes positive. So you need to add 0.5 with this from the table. And you are getting 0.5239. Normally, how you get for 0.06. Now you need to find this. This is 1 mark you are getting for this finally. Right? This is something new which you are going to do. This we haven't attempted in the questions previously. So number of put options needed. How many shares are there? 200,000 shares. It is given here in the beginning of the paragraph. It holds 200,000 shares. Right? So 200,000 shares divided by this N minus D1 multiply by 1000 shares, which is equal to 382 contracts. We need to round up. 382. How 1000 shares? How you are getting 1000 shares? Because the contract size is 1000 share each. The contract size is 1000 shares each. So you need to multiply by 1000. Now, part B. One said no hedging, the other one said we need to hedge, the other one saying we need to sell shares, the other one says like completely we have to sell shares. What's the use of the having equity? So we need to give reasons now, right? By each of the three managers. First is saying no hedging at all. Okay, will give reasons for that. And this you need to know, by the way, because there are questions which is asked, what are the benefits of hedging or what are the benefits of not hedging. You need to evaluate whether to hedge or not hedge. At that time you need these answers, so better you copy paste this answer, right? Take some points from here so that you can write. That's the reason I'm taking you through this. Otherwise I could skip this. Okay, so this argument, now we'll see why no hedging at all. This argument is based on the theory that corporate risk should not be hedged. This theory states that where a company holds a well-diversified portfolio and securities are priced correctly, unsystematic risk will at least be reduced to a minimum level or eliminated completely. Therefore, there is no apparent gain to shareholders of any further hedging or management of corporate risk. That is, unsystematic risk cannot be reduced further. See, when a company holds a well-diversified portfolio, so they are saying even if you try to hedge, it will not reduce the risk any further. Right? So, if it's not going to reduce the risk any further, if you're having an already well diversified portfolio, should hedging take place in a perfect market, it is likely that shareholders will actually lose out. So, if the market is perfect and if you try to hedge there, shareholders will lose out. You're not going to gain from hedging, you're going to lose out, the shareholders. So, as the benefits derived from hedging will be outweighed by the cost. Yes, your benefit will be less, your cost will be more. But whenever you're talking about hedging or no hedging, please make sure that you refer to this perfect market and imperfect market, because the situation is different. In perfect market you should not hedge, but in imperfect market you should hedge. So in an imperfect market, shareholders are more likely to benefit from hedging. You see, the whole point is here. So by reducing the volatility of the firm's earnings, cash flows are likely to increase. Yes, if you reduce the volatility of the firm's earning, if the firm is going to have a more stable earnings, right, if there's no so much of up and down in the earnings, cash flows will increase, which will increase the shareholders' wealth. So such a situation is likely to arise. Right? If stable earnings increase the certainty of being able to pay for the future investments, which would encourage a more stable investment policy. If tax rates are increasing, and if a high volatility of earnings could lead to financial distress for the company. Right? Now, none of the above reasons for hedging appears to exist for this company. So they are saying none of the above reasons for hedging appears for this company. Why is that? And the case for hedging seems to be weak. So they are supporting that we should not hedge in this company, because the cases for not hedging is more. Why is that? Because Marengo is a large company with numerous investments, and therefore it is unlikely that reducing the volatility of one such investment will have a significant effect on its cash flows. This is the thing. How beautifully they have linked with the case study. Marengo is a large company. How will you know it's a large company and they have so much of investment? This word itself will tell you. It holds equity investments in various companies. And only 2%, just see, only 2% in Indian companies. So do you think that by hedging they can affect so much? It's not going to have a significant impact on the company because it's just 2%. From all the investments which they have in various companies, only 2% in Indian companies. These are the points which you need to link your answer with the question requirements. You are not being general, you are being specific to the case study. So because this company is large, we are saying that hedging is not required in this case. So you need to come up with this point. Just generally, if you say hedging is good or you don't need to hedge, you will not get so much of points. But this is how you have to link. Because this company is large and it has various investments, hedging a small amount will not have so much of impact on its cash flows. Now let's go to the second point, where they are saying sell the Iran company shares in order to eliminate the risk of fall in a share price. Right? So this is based on the assumption. We'll see why they are saying. So this is based on the assumption that Marengo will be protected from a fall in Iran's share price if it gets rid of the shares in Iran. However, there are a few issues with this proposal. See how beautifully they are giving up the proposal. And there are also different paragraphs. Not all the issues in one paragraph, right? Please maintain your paragraph and your point. One point in one paragraph only. It is assumed that Marengo holds shares in Aaron as an investment and generates a greater return than risk-free rate. If Marengo sells the shares, an alternative investment offering similar returns should have to be found for the surplus funds to prevent a reduction in Marengo shareholder value. See, what happens is if you sell the shares, you are getting a return, right? You are getting a return above the risk-free rate for Aaron. So what happens is if you sell the shares, you have to find an alternative somewhere. You have to find shares where you are going to get similar returns so that it compensates you for that loss of a return, right? Because if you don't do that, what happens is there will be a reduction in the shareholders value. Shareholders value will reduce, and no company wants to reduce shareholders value, because your primary main aim in your financial management is what? Maximize shareholders value. So you always have to take action based on that one single principle: maximize shareholders value. So this thing will reduce your shareholders value, so you need to find an alternative where you can invest and get the same return, similar return. If you're not, then it's not a wise step for you to sell the shares, right? That's what they are saying. If such investments are not available, the shares should not be sold. These are all logic, all this that you can even come up with these points. This is nothing from the textbook. This is what I'm trying to show you. This is the real scenario of your exam. Not everything is from your textbook. Not everything is just directly being asked from the textbook and you can just apply. You need to think outside the box. This paper is like that. It will make you think. So the more points you can come up with, the wider you can think about a subject, you have a better chance of passing this paper. Don't just stick with your textbook. Read, read, read. Next, another issue is the potential effect on the Arian's share price if Marengo does dump a large number of shares on the market. Managers have to ask whether they are likely to be able to sell such a large proportion of Arian share, although there's a chance that investors want to take opportunity of purchasing shares at a lower price now, in the expectation that the price will increase again following the projected period of uncertainty. Right? So they are saying is, another issue is, okay, right, I want to sell something, right? Let's assume I want to sell the shares, all the shares in a company. Is it possible for me to sell such a large amount of shares at once, in one go? Who will buy the shares? I should have a buyer also, right, for the share. It's not that I want to sell and I will have a buyer also. The buyer also has to agree. But looking at this case, there is a chance, there's an opportunity that buyers will buy now from me. I can sell. Why? Because at a lower price now. This is also picked from the case study. Also go through your case study and see, search for these points, right? Because the price is low now, there's an expectation that the price will increase in the future, but the prices now are lower. So what happens is I can sell now, right? There's a chance, but still there is no certainty. We cannot guarantee that the buyers will buy. So that's another issue of trying to dump shares, trying to sell shares. Next, you need to hedge. You need to hedge. So we are going to say why. If this proposal was undertaken, Marengo would be required to purchase 382 OTC put options from the bank. Just see, when you talked about hedging, you need to talk about derivatives, right? So which derivative we are using here? Options. Which option? Over the counter OTC options. Which option? OTC put options. How many OTC put options? 382. We just calculated above. Always try to put numbers like this. Whenever you have calculated somewhere something, try to bring out wherever you can. So this is the perfect place. Hedging, financial instrument. So OTC put option is a financial instrument through which you can hedge, right? See calculations above, right? But what happens is, when we talked about option, we know what you have to do. Now we have to talk about advantages as well as disadvantages of this OTC options. So this could prove to be expensive, as Marengo will have to pay a premium on each option for the flexibility of having the right but not the obligation to exercise the option. Should the option not be exercised, right? What happens when you don't exercise the option? The company will suffer the cost of the premium for no reason. However, if the options are exercised, Marengo will have protected itself against downside movements in share price. So you see both the benefits and drawbacks you are giving in the same line itself. Now, hedging using options involves several risks. Now we'll talk about those risks. right? We all agree that when you hedge, there are risks. Everything has a risk and a benefit. Nothing in this world comes without a risk. Everything has advantage and disadvantage. So one risk is delta. Delta is not stable, right? Which means that the number of options that should have been taken out may change. Thus, Mango may not be fully protected. Options values may also change, right? The closer they come to exercise date measured by theta, because theta is a time, right? It measures time. And the underlying asset volatility changes measured by Vega, because Vega is measuring your standard deviation, changes standard deviation volatility. So despite the risk associated with derivative products, a stable hedging policy can be used to reduce the agency conflicts between shareholders and managers. A single hedging transaction is unlikely to have much impact. Here also they are not okay with hedging. They are saying a single hedging transaction is unlikely to have much impact. But it is important to maintain a consistent approach to hedging against investment risk. This protects not only shareholders' wealth but also managers who may not be as well diversified as the shareholders. So when you're talking about shareholders, try to put this sentence there, because we all know that shareholders are protected because they have a wide diversified portfolio, so their risk is eliminated, right? But not about manager does not have well diversified portfolio, so they, if hedging is there, they can be protected, managers will be protected. Now the last one, do not hold any equity investment at all. So let's see what we have to say here. Edward may be correct that Marengo should not hold equity investments. This is not a core area of business for Marengo, and it may be best not to focus on it and therefore sell all the shares. See, first they started with what? Advantage. That yes, they are correct, they should not hold because it is not their main line of business, Marengos. So they cannot even focus also. But they're also giving a disadvantage. However, this word, whenever you come to advantage to disadvantage, you need to put connecting words. However, right? It is the job of the Treasury Department to manage excess funds and liquidity, and it may be that the equity holdings deliver a valuable dividend stream, which contributes to a healthy cash flow of the business, right? Maybe because of the equity holding, you are getting a dividend, right? A valuable dividend. So, because of that valuable dividend, what happens is cash flow. It's an inflow, right? It is helping your company, helping your business. You are getting a healthy cash flow, right? Because ultimately, what you are saying is managing excess fund or liquidity is in the hand of treasury department, not yours. It is not your job, it is not the CEO's job, it is not the manager's job, it is the treasury department's job. Maybe you are getting a dividend from that equity investments, who knows, right? So the treasury department will be able to show if the investment choice outperforms the market return. Now there is no easy way to justify or discourage hedging. Either you can say that hedging is perfect, you should hedge all the time, or you should not hedge at all. You cannot say. It is not easy, it's not clear cut, it's not black and white, right? It is a gray area, gray matter. So each case should be examined on its individual merits. Everything depends on the individual cases according to situation. But it is important for a company to have a risk management strategy on which such decisions can be based, right? So that's it for question 18. And make sure that you go through delta hedging. What is delta? What is hedge ratio? And how to find number of contracts using delta hedging and all. A small portion of this might come, right? If it comes, you are safe. If it doesn't come, it doesn't come regularly, it doesn't come all the time. But if it comes, you're on the safe side, right? There's no harm in studying something and keeping ready. So that question comes from anywhere, it can attack you from anywhere. You have to be ready. That whatever question comes, you are ready to fight it back. That has to be your attitude. So that's it for today, and don't forget to subscribe to my channel, like, comment, and share. And thank you very much, and stay well.